You've probably heard the terrifying statistic that around 90% of new traders lose money. That scary number mostly comes from the world of day trading, where people buy and sell at lightning speeds. Studies have shown that 80% of day traders quit within just 2 years. But here's the thing. The traps that catch day traders are the exact same traps that snare long-term investors. They just spring a little slower. The good news is that the reasons for failure aren't a mystery. There are a handful of predictable, emotional, and tactical mistakes. So I'm going to break down the 7 most common traps and show you how to sidestep them. That way, you can join a small group of investors who actually succeed. The biggest, most destructive mistake is letting fear and greed drive your decisions. Investing should be analytical, but for most of us, it's an emotional storm. When a stock is shooting for the moon, the fear of missing out, FOMO, is almost impossible to resist. You see everyone getting rich and you jump in right at the top, just in time for the price to drop. Then, when the market takes a massive nosedive, pure fear takes over. You panic, sell everything at a loss just to stop the bleeding, which is the exact opposite of what smart investors do. And how do you fight it? You need a plan. Before a single dollar leaves your account, you must know why you're buying a stock and the exact conditions at which you will sell it, no matter what the market is screaming at you. This brings us to the second trap. Chasing huge returns without understanding the massive risk that comes with them. New investors are always enticed for the next big thing. You know, that one stock that's gonna double overnight. But let's call it what it is. That's not investing. That's gambling. These high-risk lottery tickets are incredibly tempting, but they are the fastest way to wipe out your account. Instead of hunting for these high returns, put your faith in the slow, dependable power of compounding. A well-researched, balanced portfolio might not make you a millionaire next Tuesday, but it's far more likely to build real, sustainable wealth for the long term. If you're busy chasing that one magical stock, you're far more likely to fall into this third trap, not diversifying. Going all in on 1 or 2 stocks is one of the most common rookie mistakes. You might absolutely love a company, but if that single stock or single industry gets hammered, your entire portfolio goes down with it. There's a reason don't put all of your eggs in one basket is a golden rule in investing. By spreading your money across different assets like stocks, bonds, ETFs, and across different industries, you build a buffer against risk so that when part of your portfolio is down, another one would be up, smoothing out the risk. If this is making sense and you want to learn how to invest, take a second to hit that subscribe button for more videos just like this. So, how do you pick the right basket for your eggs? That leads to our fourth trap, not doing your homework. It's truly shocking how many people throw money at something just because their friend mentioned it or they saw a post on social media. Investing without even having a basic understanding of what you're buying is a guaranteed way to lose. You don't need a finance degree, but you do need some level of due diligence. You need to read up on the company, understand its financials, and look for credible sources, not just random hype. Alright, so let's talk about the trap that even seasoned pros can't avoid. In fact, trying to time the market is one of the surest way to get the lowest return. Research has shown that missing just the 10 best days in the market can slash your return by half. And the solution is a bit of a cliche, but true. Time in the market is better than timing the market. If you invest consistently and play the long game, you'll run circles around everyone trying to predict the unpredictable. Trap number 6 is making moves without a long-term plan. Investing without a goal is like setting sail across the ocean with no compass and no destination in mind. You'll make random choices, take on risks you can't afford, and you'll probably jump ship the first time a storm hits. So before you even think about starting, define your goals. Are you saving for retirement in 30 years or a house in 5? Your timeline and your comfort level with risk will decide the right strategy for you. And the final trap, the one that ties everything together, is thinking you need to be a lone wolf. Being educated is critical, but avoiding professional advice or even just the simple tools on most platforms can be an expensive mistake. A good financial advisor can be an invaluable guide for diversification, managing risk, and most importantly, keeping your emotions from wrecking your portfolio. And unlike what you're used to, success in this game isn't about being a genius. It's about being disciplined. Avoid emotional decisions, spread your risk, do your homework, and stick to your plan. If you can steer clear of these common pitfalls, you'll be way ahead of the crowd and well on your way to joining the successful few. If this video helped you out, give it a like. And if you've ever fallen into one of these traps, let me know in the comments. And I will see you in my next video.